That takes us onto pension planning for business owners. And for business owners, pensions are often one of, if not the most tax efficient way of extracting profits. But the way that you do it does ultimately matter and also does impact your allowances and what you can do. And as you can see there, in terms of carry forward opportunities as well. Despite the fact that pensions are coming into inheritance tax world from 2027, they are still an effective way to get money from the company into something in your personal name without any tax implications to you personally at that point. So they are still a brilliant tax planning tool and growth tool for, you're growing your assets, growing things for retirement. Where they've been beneficial in the past few years is that they've also been more beneficial as well as an estate planning tool. What's actually happening is that whereas currently pensions would be left until last to be drawn on, that tends to be our advice because of the fact that they are outside of inheritance tax world, assuming that you've got an inheritance tax problem. From next year, it will be brought back into the fold to say, okay, you've got ISAs, you've got pensions, you've got other investments. Which is the most tax efficient way to ultimately draw on these tax wrappers? So if we're talking about company contributions versus personal contributions, so for business owners, employer contributions can be paid into standard personal pensions, can be paid into SIPs, so self-invested personal pensions, and can be paid into small self-administered schemes, also known as a SAS. Now, people can get hung up on, I need a SIP. Just because they're a business owner, but that's not strictly true. So what a SIP allows you to do is to have more investment flexibility. So if you want to invest in a commercial property, for example, or you want wider investment choice, certain direct shareholdings or other cash-based products that you might not be able to get in a normal pension, then that's where a SIP could be right for you. As an example, so some clients will use their pension, they'll put it into a SIP, and then they'll buy their own trading business through their self-invested personal pension. That means that the business pays rent to their pension instead of to a third party landlord, or to your pension instead of a third party landlord. That rent is deductible. It's as an expense, so you save corporation tax on that. And it grows tax efficiently within the pension. So it grows tax free within the pension. It also isn't a contribution as far as your annual allowance is concerned. So you still have your full annual allowances available. And then it also obviously moves the funds out of the trading entity, which again is potentially good for that long-term planning, building up different wrappers, different pots, depending on what the future holds for you to draw on. SASs are less common these days, but they do still exist and they are a good planning tool again. They offer another layer of flexibility over and above a SIP. So, for example, if there's multiple directors in family companies, it can lend money back to the sponsoring employer. There's strict rules around that, but you can do that. And again, it can hold commercial property. So it can be another tool for generational planning if you've got other family members in the business. It does have to be, it's its own scheme for that company. So it does have to go through HMRC registration and through the pensions regulator. So effectively, there's more administration when a SAS is set up than there would be with a SIP or with another type of pension. So if we're talking about contributions, then if you're making a company contribution, that's paid directly from the company bank account into the pension. It's normally treated as an allowable business expense as long as it passes the wholly and exclusively for the purpose of trade rules, which then means that it reduces the corporation tax. There's no employer national insurance, no employee national insurance, and no income tax on the individual at that point. So you can see it is a very effective way, if you are having a profitable year, to get money out that would be liable to corporation tax into something in your own name for later in life without incurring any tax. The difference, in a similar way to John was explaining before with dividends and salaries, etc., If you then paid that money instead to you under PAYE, then you're going to have income tax, you're going to have employer national insurance, employer national insurance, dividends. If you paid it to yourself as a dividend, you're going to have dividend tax. So then if you're then putting into a pension after that tax, is that you get that tax relief back, but it doesn't save the company in necessarily the same way. Generally speaking, the company contribution will cost the business significantly less than paying you the same amount, in effect, then particularly from a dividend perspective. The problem with paying yourself in dividends and then trying to make a pension contribution is that you're limited by what's called the annual allowance. So individual annual allowance is anything up to 60,000, but when you're making a personal contribution, you're capped depending on your earned income, and dividends don't class as earned income. So what that means is if like a lot of business owners will pay themselves, 12,000 as a salary and then will pay dividends. If, for argument, let's say you sold a property or you got an inheritance in that year and you wanted to make a pension contribution with that, you'd be limited by the 12,000 that is your salary because it's classed as earned income. If you're making a pension payment through the business as a corporate payment or a company payment, then you can pay as a business, you can pay the full 60,000. So we do find that even if it's structured in that way, that when people are taking a smaller salary and they're taking dividends, that pension contributions go through the company. Now, if you are a higher earner and you're subject to the tapered annual allowance, which means that the 60,000 starts to taper down until it gets down to 10,000, that annual allowance still applies, but it can still be paid from the company. Carry forward is a really